Okay, so this is liquidity generation, right? The fact that the market has come down, we've found support. Okay, so there's been some buying interest in this area. People are then encouraged to think that this is a buy. They put their stop losses below, only to find the market comes down, takes them out, and then continues higher. Right? How many of you have had that happen to you? Right? So the market's moving up, you pull back, we start to move higher, you buy, put your stop loss, the market goes in your direction, takes you out, and then continues higher. Okay? This move here is the liquidity generation. Okay? Alright guys, welcome back to the channel. So this is a very important concept to understand, right? When you want to understand institutional order flow, when you want to trade how the institutions are trading, right? You need to think like the institutional traders, okay? And one of the you know, the main, how do I say it? One of the main sort of advantages of being able to do so is understanding how and why liquidity is created. Okay, so this video, I'm not going to go into too much detail about why. Obviously, I'm sure a lot of people, if you've been following this channel, if you're new to this channel, maybe not so much, understand why liquidity is created. And in fact, for those people that are new, basically, I'll go through it very quickly, right? So institutions and big banks, you know, large interests in this market that are trading this market, right? Let's say they want to take up a buy position, right? Obviously, they've got a lot of money. Okay, they've got a lot of capital, and they want to buy the market. Okay, so if they just want to, let's say they want to buy a position here, they need a lot of liquidity and a lot of people on the other side of that order fill in that order so that they can get involved. Okay, otherwise they're going to move the price. So why does it? So right, okay. So basically, look, if I'm an institution and I've got a lot of capital and I want to buy into the market here, okay, I'm not here because that was a liquidity run, okay, but I want to buy into the market here. Basically, I'm going to move the market very fast, okay, and I'm going to get filled here, I'm going to get filled here, I'm going to get filled here, and my position, which you and me would be able to get filled just here, it starts to get worse and worse and worse as the price increases, okay, and that is because they're drying up all of the liquidity at all the different price points. Okay, you think there's only a certain amount of people that want to sell here, sell here, sell here, sell here, sell here, sell here, and if I want to buy, I need people that are willing to sell. Okay, so if I've got a large position and I want to buy here and I take all the liquidity from this area, I'm then going to get moved to the next price point and I'm going to dry the liquidity from that area. I'm then going to move to the next price point, I'm going to dry up the liquidity from that area. Okay, so but ultimately, institutions need liquidity in order to buy a position, they need liquidity in order to sell a position. Alright, so the concept of this video, how do institutions create liquidity? How they create liquidity is through market sentiment, okay? What are most people thinking, okay? Or how do they encourage most people to think in this market? Right, so a lot of you, I'm sure all of you, right, are gonna understand these concepts, right? So when a market is trending, okay, we are taught to wait for a pullback, and when we find some resistance, okay, we buy the market, right, on the pullback, we put our stops below the low, okay, whatever low it is, whether it's this low or that low, okay, and then we look for extended targets wherever they may be. Okay, so this is liquidity generation, right? The fact that the market has come down, we've found support, okay, so there's been some buying interest in this area. People are then encouraged to think that this is a buy. They put their stop losses below, only to find the market comes down, takes them out, and then continues higher. Right, how many of you have had that happen to you, right? So the market's moving up, you pull back, we start to move higher, you buy, put your stop loss, the market goes in your direction, takes you out, and then continues higher. Okay, this move here is the liquidity generation, okay? So let's take a look, right? Oh. Okay, so liquidity can also be generated on ranges. Okay, so markets that are range bound, right? Obviously a market's been tested, or a level's been tested numerous times. Okay, people are encouraged to put stop losses below, okay, either side of the market. Stop losses below, stop losses above, okay, if we want to short, right? But it's not just stop losses. Okay, so let's say that we've got stop losses from people that want to sell above here. Okay, so we've got buy stops above here, because if they're selling to get out of their position, they need to buy. But we've also got buy limit orders from people that potentially want to buy. Okay, so people that potentially want to buy the market, if this breaks out to the upside, are putting limit orders so that if price moves in their direction, they get tagged in, their stop loss automatically goes in. Right, so these people are out, these people are in, and then they get taken out. Okay, again, liquidity generation on both sides, right? And again, these people get taken out as well, and price most likely goes higher, okay? Or at least comes back into this order block before continuing lower, generating more liquidity, which then will get taken, right? And then we'll go something like that, okay? Right, so how is liquidity generated in the market? Let's just take a look, right? I'm not going to replay this, I'm just going to show you visually, right? So the market pushes down, we then continue higher, right? As the market is continuing higher, we pull back and we start pushing up. People put their stop losses below, them stop losses get ran, right? People also are selling this market in anticipation that this is a pullback. Okay, we've just seen this big move down here. Okay, a lot of people are probably thinking that this is just a pullback. Okay, so they start selling, we then take the liquidity from that side. Okay, we pull back, tap into the order block, continue higher, right? We pull back, push higher. Okay, pull back, generate liquidity from people that are thinking that this is a pullback. We start to continue higher before running the liquidity. Okay. Very similar situation here, right? We got highs. We find resistance here. People start selling, put their stop losses above. Bang. We then take out them stop losses. We then pull back, find resistance. What do people think? Well, we've just broken above this level. We've pulled back. We've found resistance. I'm putting my stop loss below this level and below this level. We got breakout traders that have got buy limit orders above here, as we discussed earlier. So what happens? People push up. These buy limit traders, these breakout traders tag into the market. The traders that are long from this sentiment are in the market. Bang, we take the liquidity. Okay. Similar situation here, right? We push down, we pull back, we push down, people are selling. Right, people are also buying at this level as we get this double bottom. You can see we got a double bottom here, people are buying. We sell through that liquidity and into the top side liquidity. We then pull back into the order block before moving price higher. We then pull back, generating liquidity. We push higher, run that liquidity, and then we see higher prices again, right? Again, very, very similar situation, right? We've got these lows that which we're breaking through. Okay, so look, you can see we're breaking through these lows with strong momentum. We then pull back, start to push down, people start to sell and put their stop losses above. We then run the liquidity, start to move down, people put stop losses, move down, people start to put stop losses, you start to move higher, okay, and people are now buying this as a double bottom. You can see that we've respected this level. People are buying this as a double bottom, put in stop losses. We run the liquidity through here, push higher, run the liquidity that was generated along this trend line into this order block, okay, which took the liquidity from this first initial pullback, and then we start to see lower prices. Okay, so going back to our question, right, how do institutions create liquidity? So institutions create liquidity based on market sentiment, okay? So they will temporarily buy or sell an asset to, you know, to create a sentiment in the market, to create people, to force people to believe that a certain thing is going to play out. Therefore, they will put stop losses and put orders into a certain area, into a highly probable area, and then the institutions will sell into that area, use the orders to accumulate their positions, and then take the market in the opposite direction. Okay, so it's basically, it's market manipulation, right? That is how they create liquidity in the market. They create liquidity by creating a sentiment, right, around a certain move. So the chances are, right, if you think a certain thing is going to happen, the chances are the opposite is going to happen if you don't understand these concepts. Right, I'm sure there's been been so many times, right, where you see a market that's trending, you see a pullback, you start to get in on the pullback gets taken out, and the market will continue in your direction, taking out the liquidity, right, on both sides of the market. This is where you want to be, right? You want to be, or, you know, this is where I want to be. Again, this isn't financial advice. I want to be on the side of the market that is being manipulated, okay? Or the people that are manipulating the market, right? In line with them. So let's just take a look at a few more examples, right? Okay, so let's move over here, right? We start to see we're seeing a push down, right? The market pulls back, we push down, we get liquidity generated above this high, the high gets ran, okay, the order block gets tapped into, we then move down, create a high, a lower high, which we then have liquidity above, push down, again people are selling there, people are buying there, people are buying there. People are also starting to take up buy positions in this area with stop losses below here. We then come back down, retest this area, okay, and people have got stop losses above here. Also, people have put stop losses above this area and in anticipation of lower prices, okay, anticipating this just to be a pullback just like this one. Okay, so notice this didn't get manipulated. So this didn't get manipulated, we pull back, people are thinking this is a pullback too, right? So as the market moves higher, the FOMO kicks in, they put their stop loss, right? We then hold this level. People put stop losses below here, thinking this is going to hold. We then run the area of liquidity above this level, we pull back, creating stop losses. Okay, we then run them stop losses, right? Pull back down, tap into that order block. Where are we going next? Oh, look, to this liquidity, okay, that was generated or created through a market sentiment, okay, through making you think a certain way, right? We start to see a push higher, again, liquidity generation, right? Push back down into the liquidity, but shorter term, what's happening here, right? If we was to look on a 1 minute time frame or a 5 minute time frame at this area, so let's just clean this up a little bit and I'll just show you what I mean. Okay, so if we look in this area here, this is a short-term trend. Right, not there, so something like that. Let's just pull this back so we can see. Let's look at it on a 5 minute, right? Notice what's happening on a 5 minute time frame. So this is happening all throughout, you know, every time frame, right? We got liquidity generation. We're pulling back. We got liquidity generation, and this is just one side of the market. Bear in mind, liquidity generation. We're pulling back. Liquidity generation. Okay, liquidity generation. We then take a little bit of that liquidity. Liquidity generation. Right. Where have we come to? Okay, so we got liquidity, liquidity, liquidity. We've got a load of buy orders. Or we got a load of sell orders, sorry. So we got sells here, right? We then push down into these sells, accumulate buys to then take all the liquidity above this level, right? Loads of liquidity above this level. Again, you can see the accumulation of price. Okay, if we just take a look, if we just get rid of that, we look down here. For those of you familiar with the Wyckoff schematics, right, this is going to look very familiar to you here. Okay, this accumulation of price. Okay. And where do we go? We literally run all of this liquidity, and you can see how much liquidity is here because of the way price runs it, okay? The amount of imbalance that is created through that area, okay? Again, even on a shorter time frame, right? What's happening, okay? We get a push up, a strong push up, a pullback. We start to reject. People don't want to get FOMO'd in, okay? They don't want to miss this move, okay? We're just in a really sharp push off. They buy, they put their stop loss below this level. Oh, look, it gets taken, right? Where is price likely to come into? The area in which the selling pressure started to mitigate from them negative sells to then take price higher, potentially. I don't actually know, right? Again, accumulating positions in this area, generating liquidity, okay, through these equal lows. Before we start to see higher prices, okay? Let's just zoom out. That's a higher time frame. Higher prices, right? And again, a lot of liquidity generation through there. Bang. Big, strong move through that liquidity. And then we come back down, fill the imbalance, and tap into an order block. Again, look, very repetitive thing. We push up, we pull back. We generate liquidity. We then push higher. We run the liquidity, okay? We push higher, right? We push higher, we pull back, see some rejection, generate some liquidity, we run the liquidity, potentially higher prices. Oh look, higher prices, okay, after we've run the liquidity. So I hope that makes sense. I hope that gives you a better understanding of how institutions create liquidity in the market, right, and how they then use it to drive their own price. All right, so again, I hope you got value from the video. If you did, be sure to hit the like button, subscribe to the channel for similar content, and wherever you are on your trading journey, I hope you have a good week, and I'll see you on the next one.